Hello listeners, I am Tushar Bharambe, Assistant Vice President at ICRA Limited. Through this podcast, I'll be sharing our views on the cement sector. ICRA expects the cement volumes to grow by 4 to 5% year on year to 445 to 450 million metric ton in FY25 compared to its earlier growth forecast of 7 to 8% released in July 2024. This is on account of slower than expected ramp up in construction activity across the housing and infrastructure sectors post the general elections. The All India cement volumes witnessed a muted growth of 2% year on year to 212 million metric ton in H1 FY25 on account of the slow pace of construction in Q1 during the elections followed by monsoons in Q2. The likely improvement in farm cash flows backed by healthy monsoons and upbeat kharif output and elevated replenishment levels of reservoirs supporting the rabi crop sowings are expected to boost the rural consumption in H2 FY25, which should aid the cement demand for the rural housing segment. Additionally, the sustained healthy demand for urban housing should also support the pickup in cement volumes. The infrastructure segment is likely to witness a greater traction in H2 FY25, supported by an increase in government spending on infrastructure projects. The Government of India's gross capex spend in H1 FY25 remained subdued at Rs 4 trillion against the revised budget estimate of Rs 11.1 trillion for the full year FY25. The substantial headroom for the Government of India's capital spending in H2 FY25 to meet its full year estimate is likely to provide a fillip to construction activity and aid in supporting the allied input sectors like cement. The cement prices remained under pressure, declining by 10% year on year to Rs 330 per bag in H1 FY25 due to muted demand and oversupply in the market. While the lower sales realizations were partially offset by moderation in costs of coal and petcoke, which declined by 38% and 13% year on year in H1 FY25 respectively, the EBITDA per metric ton of cement companies in ICRA's sample set remained subdued and contracted by 19% year on year to Rs 722 per metric ton. On a year on year basis, the operating profit margins declined by 192 basis points to 14% in H1 FY25. Talking about the expected profitability for full year FY25, ICRA anticipates the operating performance of the cement companies to improve from Q3 FY25 onwards, supported by the likely price hikes, uptick in cement volumes aided by increased government spending on infrastructure projects, pickup in construction activities, and stable input cost pressures primarily pertaining to power and fuel. However, despite the likely improvement in H2 FY25, the EBITDA per metric ton of the cement companies in ICRA's sample set is estimated to remain under pressure for full year FY25, declining by 12 to 15% on a year-on-year basis to Rs 820 to 850 per metric ton. ICRA's revised estimate of EBITDA per metric ton is lower by Rs 150 to 180 per metric ton compared to its earlier forecast of Rs 975 to 1000 per metric ton released in July 2024. Consequently, the operating profit margins for FY25 are likely to decline by 130 to 180 basis points to 15.6 to 16.1% from 17.4% in FY24. Lastly, coming to the capacity additions and utilization levels, ICRA estimates the capacity addition in the cement industry to be at 70 to 75 million metric ton during FY25 to FY26 period, of which 33 to 37 million metric ton per annum is expected to be clinker capacity and the remaining will be grinding capacity. Around 33 to 35 million metric ton capacity is likely to be added in FY25, while 37 to 39 million metric ton addition is expected in FY26. The eastern and southern regions are expected to lead the expansion during FY25 to FY26 period with a combined addition of 38 to 40 million metric ton capacity, equally split between the two regions. The capacity utilization is estimated to remain moderate at 70% in FY25 on an expanded base similar to FY24 levels. With this, we come to the end of this podcast. Thank you for listening and stay tuned for the upcoming podcast.